There is a simple, almost childlike idea that separates the investing legends from the crowd. It's an idea so powerful it can transform a portfolio of scattered, mediocre bets into a concentrated portfolio of masterpieces. It's a concept that has underpinned the creation of one of the world's greatest fortunes, yet it's rarely taught in business schools and almost universally ignored by the financial media. The man who perfected this idea is Warren Buffett, and he summarized it with a powerful mental model. He said, "Imagine that when you are born, you are given a punch card. This card has just 20 slots on it, and those 20 slots represent the total number of investments you are allowed to make in your entire lifetime. Once you've punched all 20, you're done. You can't make any more." Under those rules, he asked, how would you behave? You would think very, very carefully about each and every decision. You would reject almost everything that came your way. You would wait patiently for the absolute perfect pitch, the one you understood completely and felt with deep conviction was a near certainty to succeed. You wouldn't swing at every opportunity. You would only swing at the ones that were right in your sweet spot. You would do immense research because you couldn't afford to be wrong, and once you made a decision, once you punched that card, you would stick with it. You would see it as a precious, irreplaceable commitment. This is the 20-slot punch card philosophy, and it is the genetic code behind the Berkshire Hathaway empire. It is a radical departure from the conventional wisdom that tells you to diversify, to own hundreds of stocks, to constantly rebalance, and to always be active. That conventional path, the path of the 99%, is a path to mediocrity. It's a strategy designed to protect you from ignorance. If you don't know what you're doing, then yes, owning a little bit of everything is the safest course of action. But it is also a mathematical guarantee that you will never, ever achieve extraordinary results. The punch card philosophy is the opposite. It is a strategy for those who choose to be knowledgeable. It is a forcing mechanism for discipline, patience, and high-conviction betting. It's the difference between being a collector of stocks and a curator of businesses. And it is the single most important mental shift you can make if your goal isn't just to keep up with the market, but to achieve true financial freedom and build life-changing wealth. Over the next hour, we are going to deconstruct this powerful idea into its 5 fundamental pillars. We will journey through the specific deals, the psychological biases, and the hard financial realities that make this strategy so potent. This isn't just a lesson in stock picking. It's a masterclass in capital allocation, executive decision-making, and building a true CEO mindset. This is the final promise of investing, the promise that by making fewer, better decisions, you can win far, far bigger. The first pillar, the very foundation of this entire philosophy, is understanding the genesis of concentration itself. It's the mental leap from seeing the investment world as a casino with thousands of flashing lights, each demanding your attention, to seeing it as a quiet art gallery containing only a few priceless masterpieces. The goal is not to sample everything, but to acquire 1 or 2 of those masterpieces for your own. The punch card is the tool that forces this perceptual shift. It introduces a profound sense of scarcity into a world that screams of infinite opportunity. And no story illustrates the power of this focused mindset better than Warren Buffett's daring investment in the Washington Post Company back in the early 1970s. To truly appreciate the courage of this decision, you have to understand the context of the time. The market was in turmoil. The Nifty 50 era, a period where investors believed you could pay any price for a group of 50 large blue-chip growth stocks, was coming to a brutal end. These once unassailable giants of American business, companies like Polaroid, Avon, and Xerox, were collapsing, with many falling 80% or more from their peaks. The S&P 500 itself was in the midst of a gut-wrenching bear market that would ultimately slash its value nearly in half. Fear was rampant. The prevailing wisdom was to sell, to diversify into cash or bonds, to protect what little you had left. It was a time of panic, not of aggressive, concentrated buying. Adding to this financial chaos was a political firestorm centered directly on the Washington Post. The paper, under the leadership of its publisher Katharine Graham, was aggressively pursuing a story about a break-in at the Democratic National Committee headquarters in the Watergate office complex. Their reporting, led by Bob Woodward and Carl Bernstein, was pointing directly toward the Nixon White House. This was an unprecedented situation. The federal government, the most powerful institution on Earth, was putting immense pressure on the company. Licenses for their highly profitable television stations, a core part of the company's value, were being challenged by administration allies. The political risk was enormous. The stock market, which hates uncertainty above all else, reacted predictably. The Washington Post stock was crushed. By 1973, the entire company, including the flagship newspaper, Newsweek magazine, several network-affiliated television stations, and other assets, had a total market capitalization of just $80 million. This is where Buffett, armed with his mental punch card, saw not risk, but an extraordinary opportunity. While the rest of the world was focused on the Watergate headlines and the stock ticker, Buffett was doing the hard, tedious work of a business analyst. He wasn't buying a story, he was evaluating a collection of assets. He recognized that the television stations alone were probably worth more than the entire $80 million market cap. He understood that a major newspaper in a capital city, especially one with a near-monopolistic grip on its market, was a phenomenal business, what he would later call a franchise. It had pricing power, reader loyalty, and a durable competitive advantage. He saw that Katharine Graham was a tough, principled leader who would not buckle under political pressure. In his analysis, the market was making a classic mistake. It was confusing temporary, headline-driven fear with permanent impairment of business value. The market was focused on the short-term storm. Buffett was focused on the long-term durability of the economic castle, so he began to buy. He didn't nibble. He didn't diversify his bet. He swung for the fences. Over the next year, he invested $10.6 million of his partnership's capital into the Washington Post's stock, acquiring a massive chunk of the company. In his mind, he was punching a slot on his card. This was one of his 20 lifetime decisions. It was a bet born not of speculation, but of deep research and high conviction. The result was legendary. The market panic eventually subsided. The Post's journalism was vindicated, winning a Pulitzer Prize. The business not only survived but thrived. That $10.6 million investment, a single punch on his card, would grow to be worth over $1 billion by the early 2000s, a 100-fold return that generated hundreds of millions in dividends along the way. It became one of the foundational investments of Berkshire Hathaway. This story is the perfect embodiment of the punch card philosophy. It required ignoring the screaming crowd, focusing on business fundamentals instead of market sentiment, and having the courage to make a large, concentrated bet when all the analysis pointed to a massive mispricing. It was a decision made possible only by a mindset that values quality of decisions over quantity. The reason this punch card approach works so effectively is that it hijacks our own brain chemistry. It takes common psychological biases that usually lead to poor investment outcomes and weaponizes them for our benefit. The two most powerful principles at play here are commitment and consistency bias, and a close cousin, the endowment effect. Commitment and consistency bias describes our deep-seated psychological need to be consistent with things we have already said or done. Once we make a choice or take a stand, we feel personal and interpersonal pressure to behave consistently with that commitment. Politicians call it staying on message. Psychologists see it as a mental shortcut to simplify decision-making. In investing, it's often a trap. An investor buys a stock, it goes down, and instead of reevaluating the thesis, they feel committed to their original decision and hold on, or worse, average down on a losing bet simply to remain consistent with their initial choice. The punch card, however, turns this bias into a powerful tool for good. When you know you only have 20 decisions for your entire life, the act of making a decision, of physically or metaphorically punching that card, becomes a profound moment of commitment. It's not a casual click of a mouse. It's a formal declaration. You are saying, out of all the thousands of companies in the world, This is one of the 20 I am choosing to back for the long haul. This heightened sense of commitment forces you to do the work up front. You can't afford to be casually committed to one of your 20 slots. The psychological weight of the decision demands deep research and a robust, well-articulated thesis. The commitment isn't to the stock price, it's to the business thesis. This ensures that when the stock inevitably goes through periods of volatility, your anchor is your original, well-researched conviction, not the fickle whims of the market. You remain consistent with your thesis, not with a fluctuating price. Then there's the endowment effect. This is the tendency for people to ascribe more value to things merely because they own them. In a famous experiment, participants were given a coffee mug and then offered the chance to sell it. The price they demanded to part with the mug was consistently and significantly higher than the price they themselves would have been willing to pay to acquire it just moments before. Ownership creates an emotional attachment that inflates perceived value. For the typical investor who owns 50 or 100 stocks, this effect is diluted and often unhelpful. They don't feel a deep sense of ownership for any single position. But for the punch card investor, the endowment effect becomes a superpower. Each of your 20 slots is a precious, almost sacred piece of property. You own it in a much deeper sense. This creates a powerful and healthy resistance to selling. You won't be tempted to trade away one of your crown jewels for a quick profit, or to chase a hot news story. To sell one of your 20 lifetime holdings, the reason must be overwhelmingly compelling. Either the original thesis has been proven wrong, or a new opportunity has presented itself that is so much better, it justifies giving up one of your irreplaceable slots. This dramatically reduces the hyperactivity and constant churn that destroys returns for most investors. The fear of missing out, or FOMO, is overpowered by the fear of losing a proven winner. These two biases, when channeled by the punch card framework, create the ideal investor temperament. You are incredibly careful and selective on the buy side, and incredibly patient and reluctant on the sell side. You act like a true business owner, not a trader of paper slips. So how do we translate this powerful theory into a practical, repeatable process? We can create a blueprint, an applied mental model that any investor can use to implement the 20-slot punch card in their own financial life. It's a 4-step process designed to instill discipline and transform your approach to portfolio management. The first step is the physical creation of the card itself. This might sound trivial, but it's a crucial psychological device. Get a piece of cardstock or create a simple document on your computer. Make a grid with 20 empty boxes. This tangible object is your new investing constitution. It sits on your desk as a constant, physical reminder of the scarcity of your decisions. Every time you get a hot tip or read an exciting headline, you must look at this card and ask, is this idea so good, so certain, so within my circle of competence, that I am willing to permanently use up one of my 20 lifetime slots for it? 99% of the time, the honest answer will be no. This simple act of physicalization transforms an abstract concept into a concrete rule. The second step is to create a non-negotiable pre-punch checklist. This is your filter. Before a company can even be considered for a punch, it must pass a series of rigorous tests. This checklist is personal, but it should be based on the time-tested principles of value investing. For example, your checklist might include: 1. Is the business simple and understandable? Can I explain how it makes money and what its competitive advantages are? 2. Does the business have a durable competitive advantage, a long-term moat that protects it from competition? 3. Is the management team honest, capable, and acting in the best interests of shareholders? 4. Is the stock trading at a significant discount to my conservative estimate of its intrinsic value? This provides a quote, margin of safety. Only when an idea clears every single one of these hurdles can it be brought before the final judgment of the punch card. The third step is the punch ritual itself. This is the act of formal commitment. When you decide to invest, you take your card and you fill in one of the slots. You write the name of the company, the date, the price you paid, and most importantly, a one-paragraph summary of your investment thesis. Why are you buying this business? What do you expect to happen over the next 10 years? This act of writing it down solidifies your commitment and provides a clear benchmark against which to measure future results. It's no longer a casual bet. It's a documented, strategic capital allocation decision. The final step is the ongoing punch review. Once a quarter, you should review your punched slots. But this review is not about checking the stock prices. That is the amateur's game. Your review is about rereading the one-paragraph thesis you wrote for each investment. You ask a single powerful question. Based on everything I know today, the company's recent performance, industry trends, and the actions of competitors, is my original thesis still fundamentally intact? If the answer is yes, you do nothing, even if the stock price is down 30%. In fact, a price drop in a business whose thesis is still intact should be seen as an opportunity to potentially add to your position, if you have another slot you're willing to use. If the answer is no, if some fundamental aspect of the business has deteriorated and your original thesis is broken, only then do you consider selling. This process decouples your decision-making from the emotional roller coaster of the stock market and anchors it to the rational foundation of business analysis. Following this four-step blueprint, create the card, use the checklist, perform the ritual, and conduct the review, will systematically force you to behave like Warren Buffett. It builds the habits of patience, selectivity, and long-term thinking directly into your investment process. To fully grasp the power of the punch card, we must examine its antithesis, the path of the 99%. This is the approach taken by the vast majority of retail investors, and it's a recipe for guaranteed mediocrity, if not outright disaster. The typical investor's portfolio looks less like a curated museum and more like a cluttered garage sale. It's a chaotic, haphazard collection of dozens, sometimes hundreds, of different stocks, ETFs, and mutual funds. There's no coherent strategy. There's a few shares of a tech giant they bought because they like its products. There are a handful of meme stocks they bought on a tip from a social media forum. There's a position in an obscure biotech company based on a story about a miracle drug. There are several overlapping index funds because a financial advisor told them to diversify. They are a collector, not a curator. This approach, which is often sold under the guise of diversification, is what Peter Lynch famously called diversification. It's the process of adding more and more investments to a portfolio to the point that the potential for exceptional returns is completely eliminated. The fundamental problem is that it's impossible for any individual to truly understand and follow 50 different businesses. The investor has a shallow, surface-level knowledge of each, but a deep, fundamental understanding of none. They are tracking price movements, not business performance. The consequences of this approach are devastating and threefold. First, it leads to immense financial costs. Constantly buying and selling, chasing new ideas, and rebalancing this unwieldy collection of assets racks up enormous transaction fees and commissions. More insidiously, it triggers frequent taxable events, forcing the investor to give a significant slice of any gains back to the government each year, crippling the long-term compounding process. Second, it creates a state of perpetual emotional whiplash. Trying to follow dozens of different stories and price charts is mentally exhausting. The investor is constantly reacting to news, getting whipsawed by market volatility, and making fear-based decisions. They are perpetually anxious, checking their portfolio multiple times a day, a slave to the green and red tickers on the screen. There is no peace, only a constant, low-grade panic. Finally, and most importantly, it is a mathematical certainty that this approach will produce, at best, average returns. By owning a little bit of everything, you are essentially building your own expensive, inefficient index fund. Your winners will be canceled out by your losers. Your brilliant insights will be drowned in a sea of mediocrity. You have diversified away your single greatest advantage as an individual investor: the ability to do nothing and to bet big only when you have a massive informational or analytical edge. The path of the 99% feels safe, but it is a trap. It is the illusion of activity masquerading as a strategy, and it is the surest way to ensure you never achieve your most ambitious financial goals. The financial connection here is the most direct and powerful of all. The 20-slot punch card philosophy is not just a nice mental model. It is a machine for manufacturing superior financial returns. It achieves this by fundamentally altering the mathematics of your portfolio and your entire approach to capital allocation. Let's quantify the impact. Imagine two investors, both starting with $100,000. Investor A follows the path of the 99%. They build a diversified portfolio of 100 different stocks and ETFs. They are active, they rebalance, and they aim to match the market. After fees and taxes, they manage to earn a respectable 9% annualized return, slightly above the historical average of the S&P 500. Investor B adopts the 20-slot punch card philosophy. They spend years doing nothing, patiently waiting. They pass on hundreds of ideas. Finally, they find a handful of truly wonderful businesses that they understand deeply, run by honest managers, with durable competitive advantages, all trading at a significant discount to their intrinsic value. They build a concentrated portfolio of just 10 of these high-conviction ideas. Because they are only investing in their absolute best ideas, and because they are holding them for the long term to allow the businesses to compound in value, their portfolio generates a higher annualized return of 18%. This is not an outlandish figure. It is well within the historical performance range of many focused, value-oriented investors. Now, let's let the magic of compounding do its work over a 30-year investment horizon. Investor A, the diversifier, with their 9% return, sees their initial $100,000 grow to approximately $1.33 million. This is a fantastic outcome, far better than what most people achieve. It's a comfortable retirement. But now look at Investor B, the punch card investor. Their $100,000, compounding at 18% per year, grows to over $14.3 million. That is not just a comfortable retirement. That is generational wealth. It is financial freedom on a completely different scale. The difference between these two outcomes is more than $13 million. And what created that difference? Not a higher IQ, not access to secret information, not a complex algorithm. It was a simple mental model. It was the discipline to make fewer, better decisions. The punch card forces you to shift your entire financial strategy from a shotgun to a sniper rifle. Instead of spraying your capital thinly across the entire market, you are directing it with immense force at a few well-chosen targets. This principle of concentration is the engine of all great wealth creation. Every great fortune, whether in business or investing, can be traced back to a period of intense, concentrated focus on a single great idea or asset. The 20-slot punch card is the system that allows the individual retail investor to replicate that same powerful dynamic in their own portfolio management. It is the bridge from average to extraordinary. Now we arrive at the second great pillar of this philosophy, a direct and forceful confrontation with one of the most sacred cows of modern finance, diversification. The financial establishment preaches diversification as the ultimate virtue. It's presented as the only responsible way to manage money, a free lunch that reduces risk without reducing returns. But Warren Buffett and his partner Charlie Munger have a radically different view. Munger has famously said, "The whole idea of diversification when you're investing for the long term is madness." To them, the conventional wisdom is not just wrong, it's a dangerous illusion of safety that dooms the average investor to a lifetime of mediocre results. The perfect story to illustrate this radical viewpoint is Buffett's breathtakingly bold investment in American Express during the infamous salad oil scandal of 1963. It was a moment that would define his early career and demonstrate that true investment safety comes from deep knowledge, not from spreading your bets. The scandal itself was the stuff of financial thrillers. A company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation had been borrowing vast sums of money from banks and financial institutions, including a subsidiary of American Express. The loans were secured by the company's inventory of salad oil, which was supposedly held in giant storage tanks. The problem was, the tanks were mostly filled with seawater, with only a thin layer of oil floating on top. When the fraud was discovered, Allied Crude collapsed, leaving its creditors, including American Express, on the hook for what was then an astronomical sum of money, the equivalent of over $1 billion today. Wall Street panicked. American Express stock, a blue-chip darling, was eviscerated. It plunged by more than 50% in a matter of weeks. The consensus view was that the company was ruined. The potential liabilities from the fraud, everyone believed, would wipe out its net worth. The herd was stampeding for the exits. This is the precise moment when a conventional, diversification-focused investor would have sold any remaining shares to mitigate risk. But Buffett, operating with his punch card mentality, did the exact opposite. He saw the panic as a potential opportunity to make a massive, concentrated bet. He refused to accept the market's verdict without doing his own investigation. He didn't just read the newspaper headlines. He engaged in what he called scuttlebutt. He went out into the real world to see if the scandal had damaged American Express's core businesses. He went to restaurants and travel agencies. He talked to bank tellers. He observed customers. He was asking one simple question: are people still using American Express travelers' checks and credit cards? The answer he found was a resounding yes. The scandal was confined to one subsidiary, the warehouse division. The core financial products, which were built on the powerful foundation of consumer trust and the company's global brand, were completely unaffected. The traveling public and the business community hadn't lost faith. In fact, many were fiercely loyal to the brand. Buffett concluded that the fundamental earning power of the American Express franchise was intact. The market was confusing a massive but manageable one-time loss with the destruction of a great business. He calculated that even under a worst-case scenario for the salad oil liabilities, the company's underlying value was far, far higher than its current stock price. So what did he do? He didn't just buy a few shares. He didn't make it a quote-quote small speculative position in a diversified portfolio. He made it the single largest investment of his career up to that point. He committed a staggering 40% of his entire investment partnership's capital to American Express stock. He took a massive swing. He punched his card with tremendous force. It was the ultimate anti-diversification move. And he was right. American Express weathered the storm, settled the liabilities, and its stock came roaring back. Within a few years, Buffett had made a fortune for his partners. This story powerfully illustrates his core belief. Risk is not about how many stocks you own. Risk comes from not knowing what you're doing. For Buffett, owning 50 companies he barely understood was far riskier than owning one company he understood completely. True safety wasn't in the number of his holdings. It was in the depth of his knowledge. The reason the vast majority of people cling to diversification, even when it guarantees mediocrity, is rooted in deep-seated psychological biases that are hardwired into our brains. The two most powerful forces at play are ambiguity aversion and the ever-present pull of herd mentality. Ambiguity aversion is our natural tendency to prefer known risks over unknown risks. We would rather choose an option with a clear, defined probability of success, even if it's low, than an option with an unknown or uncertain probability, even if the potential payoff is much higher. In a famous experiment known as the Ellsberg paradox, people were offered a chance to draw a ball from an urn. Urn A contained exactly 50 red balls and 50 black balls. Urn B contained 100 balls, but the mix of red and black was unknown. When asked to bet on drawing a red ball, the overwhelming majority chose to bet on Urn A. They preferred the known 50% probability over the ambiguous, unknown probability of Urn B, even though, rationally, the probability for Urn B could be anything from 0% to 100%, with an average of 50%. We hate ambiguity. Now let's apply this to investing. A broadly diversified portfolio like an S&P 500 index fund feels like Urn A. The risks feel known. The range of outcomes seems defined and stable. It's the safe, unambiguous choice. A concentrated portfolio of just a few stocks feels like earn B. The potential outcomes are extreme. It could be a spectacular success or a devastating failure. The ambiguity is high. This makes most people deeply uncomfortable, so they retreat to the false certainty of the diversified portfolio. Warren Buffett's genius is in completely inverting this framework. Through deep research, he works to eliminate the ambiguity. For him, investing 40% of his capital in American Express in 1963 was not a bet on an unknown quantity. It was a bet on a known certainty, the certainty that the company's brand and earning power were intact. For him, the S&P 500 is the real earn B. It's a collection of 500 businesses, the vast majority of which he hasn't studied and doesn't understand. Investing in that, for him, would be the true gamble. He believes that ignorance is the real source of risk, and diversification is just a fancy name for investing in your own ignorance. The second force, herd mentality, is our primal instinct to follow the crowd. For millennia, sticking with the tribe was a survival mechanism. The person who wandered off alone was more likely to be eaten by a predator. In modern finance, this instinct manifests as a powerful desire to do what everyone else is doing. When the market is soaring, the herd buys. When the market is crashing, the herd sells. And when it comes to portfolio construction, the herd diversifies. Everyone knows that diversification is the smart thing to do. Financial advisors preach it, the media reinforces it, and so people follow along, assuming that if everyone is doing it, it must be correct. This creates a powerful but false sense of security. The problem is that in investing, the herd is almost always wrong at critical turning points. The consensus view is what is already priced into the market. To achieve superior returns, you must, by definition, do something different from the herd. The punch-card philosophy is a conscious, deliberate decision to leave the herd. It's an embrace of intellectual independence. It's the courage to stand alone, armed not with popular opinion, but with your own deep research and analysis. It is the only way to escape the gravitational pull of average that traps the herd. To operationalize this counterintuitive idea and build a portfolio based on knowledge rather than diversification, we need a practical mental model. The most effective tool for this is the Circle of Competence audit. This is a rigorous, honest self-assessment that forms the bedrock of a concentrated, high-conviction investment strategy. It's a four-step process. The first and most important step is to define your circle. Take out a piece of paper and write down the industries, business models, and technologies that you genuinely understand, with a level of expertise that goes far beyond that of a casual observer. This is not about what's popular or what's making headlines. This is about what you know cold. Maybe you've worked in the banking industry for 20 years. Maybe you're a software engineer who deeply understands cloud computing. Maybe you're a marketing executive with an expert grasp of consumer brands. Be brutally honest with yourself. Your list will likely be very short. That's not a sign of weakness. It's a sign of intellectual honesty, which is the cornerstone of great investing. As Buffett says, you don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. The second step is to apply the competence filter to every new idea. Before you spend a single minute researching a potential investment, it must pass a simple binary test. Is this business squarely inside my defined circle of competence? If the answer is no, you immediately discard the idea. You put it in what Charlie Munger calls the too hard pile. This isn't laziness, it's an act of supreme discipline. It conserves your most valuable resource, your time and mental energy, for the few opportunities where you can develop a genuine analytical edge. You must resist the temptation to wander outside your circle, no matter how exciting the story sounds. The third step is the portfolio purge. Go through your current investment portfolio, line by line. For each holding, ask the hard question, is this company inside my circle of competence? If you own a biotech stock but you're not a scientist, or a complex financial derivatives company but you're not a banker, you must be ruthless. You sell the position. It doesn't matter if you have a profit or a loss. You are not selling because the stock is good or bad. You are selling because you have no business owning it. You are managing risk at the most fundamental level, the risk of ignorance. This process will likely result in a much smaller, more concentrated portfolio, which is precisely the goal. The final step is to create a plan for deliberately and slowly expanding your circle over time. Your circle of competence is not static. You can widen its boundaries through dedicated study and effort. Choose an adjacent industry or technology that interests you and commit to learning it. Read books, study the major companies, listen to conference calls, and talk to experts. Over a period of years, you can develop a new area of expertise. But this must be a conscious, deliberate process of learning, not a random reactive process of chasing hot stocks. This four-part audit, define, filter, purge, and expand, is the practical guide to escaping the diversification trap. It transforms your portfolio from a random collection of bets into a curated selection of businesses you understand, as well as an owner. The antithesis to this disciplined approach is what can be called the Noah's Ark style of portfolio management. The idea, often implicitly followed by investors, is to buy two of everything. Two big tech stocks, two big bank stocks, two big industrial stocks, and so on. They end up with a portfolio that is a sprawling, over-diversified menagerie of assets. They own some of the best companies in the world, but their performance is shackled by the fact that they also own many of the worst. Their winners are inevitably dragged down by the dead weight of their losers. The modern and more insidious version of this is the ETF collector. An investor might own an S&P 500 ETF, a NASDAQ 100 ETF, a growth ETF, and a value ETF. They believe they have constructed a sophisticated, diversified portfolio. But when you look under the hood, you discover a massive overlap. They end up owning the same 50 megacap technology and consumer stocks in 4 different wrappers, all while paying 4 separate layers of management fees for the privilege. This isn't diversification, it's redundant diversification. It creates the illusion of safety and sophistication, while guaranteeing you will never break away from the performance of the herd. The core error of the Noah's Ark approach is that it is built on a foundation of fear and ignorance. The investor is so afraid of being wrong about any single company that they choose to be a little bit right about all of them, which, by extension, means they are also a little bit wrong about all of them. They have protected themselves from the risk of catastrophic failure, but they have also completely eliminated any possibility of spectacular success. They are playing not to win. They are playing not to lose. This mindset is a prison. It locks the investor into a world of incremental gains and average outcomes. They spend their time rearranging the deck chairs on their financial Titanic, rebalancing from one mediocre asset to another, instead of focusing their energy on the 1 or 2 tasks that actually create wealth, identifying truly exceptional businesses, and buying them at intelligent prices. The Noah's Ark investor is perpetually busy, but their activity signifies nothing. They are a hamster on a wheel, running furiously but going nowhere, all while convincing themselves that their motion is a sign of progress. The financial connection between diversification and mediocre returns is ironclad. It hinges on understanding the true definition of risk. The academic world defines risk as volatility, the degree to which a stock's price fluctuates up and down. By this definition, a concentrated portfolio is riskier than a diversified one, because its value will likely be more volatile in the short term. But for a long-term business owner and investor like Warren Buffett, this definition is absurd. Volatility is not risk. A temporary 30% drop in the price of a wonderful business is not a risk. It's an opportunity. The only real risk, he argues, is the permanent loss of capital. And what is the biggest cause of permanent capital loss? Investing in a business you don't understand. or overpaying for a business you do. Broad diversification actively encourages both of these errors. It encourages you to own dozens of businesses you can't possibly understand, increasing the odds that some of them are fundamentally flawed and destined for failure. And by encouraging a buy-the-market mentality, it often leads investors to buy into wildly overvalued assets at the peak of market bubbles. A concentrated portfolio, managed correctly within a circle of competence, dramatically reduces the risk of permanent capital loss. While its short-term volatility might be higher, the deep understanding you have of each of your few holdings, combined with the discipline of only buying with a significant margin of safety, provides a far more robust form of protection against ultimate failure. Furthermore, this approach is the only path to generating true market alpha. Alpha is the financial term for returns that are in excess of the market's return. By definition, you cannot generate alpha by hugging the market. You cannot be different and the same at the same time. To beat the S&P 500, your portfolio must look significantly different from the S&P 500. Concentration is the most potent expression of this difference. It is a declaration that you are not content with average. You are making a conscious decision to deviate from the benchmark in a significant way, based on your own superior research and analysis. In doing so, you accept the possibility of underperforming the market, but you also open up the possibility of massively outperforming it over the long run. Diversification is a ceiling on your potential. Concentration is the launching pad. It is the deliberate financial choice to trade the guarantee of mediocrity for the possibility of greatness. The third pillar, and perhaps the one that requires the most profound shift in temperament, is the power of inaction and patience. After you've done the exhaustive research and used one of your precious 20 punches, the hardest part begins: doing absolutely nothing. In a world that glorifies action, speed, and constant activity, the idea of strategic patience is deeply countercultural. Yet, it is the secret ingredient that allows the magic of compounding to work. Charlie Munger summarized this ethos perfectly. The big money is not in the buying and selling, but in the waiting. This is the sit-on-your-ass strategy, and no story tells it better than Berkshire Hathaway's acquisition and long-term ownership of See's Candies. In 1972, Warren Buffett and Charlie Munger were presented with an opportunity to buy See's Candies, a beloved West Coast manufacturer and retailer of boxed chocolates. By all conventional metrics of the time, it wasn't a particularly exciting business. It wasn't a technology company. It wasn't a global conglomerate. Its growth prospects seemed limited, mostly confined to its existing geographical footprint. The asking price was $30 million, but Buffett and Munger, being disciplined value investors, were only willing to pay $25 million. After some negotiation, the See's family agreed to their price, and Berkshire Hathaway became the owner of a chocolate company. Now, here is where the story diverges from the path of the 99%. A modern private equity firm or active portfolio manager might have bought See's with a plan to optimize it. They would have cut costs, perhaps cheapened the ingredients to boost margins, expanded aggressively into new markets, and then tried to sell or flip the company for a quick profit a few years later. They would have been focused on short-term action to create a short-term result. Buffett and Munger did the opposite. They did almost nothing. They recognized that the source of See's value was not its growth potential, but its incredibly powerful brand and the deep customer loyalty it commanded. For decades, customers had been giving See's chocolates as gifts for birthdays, holidays, and special occasions. The brand was associated with quality, nostalgia, and affection. This gave the business tremendous pricing power. Each year, they could raise the price of their chocolates a little bit, and customers would happily pay it because the emotional value of the gift far outweighed the small increase in cost. So Buffett and Munger's strategy was simply to not mess it up. They kept the existing management. They didn't compromise on the quality of the ingredients. They just let the business continue to do what it did best: make great chocolate and build customer loyalty. And they sat and they waited. For years, for decades. The results of this strategic inaction have been nothing short of breathtaking. That initial $25 million investment in See's Candies has, to date, generated over $2 billion in pre-tax earnings for Berkshire Hathaway. All of that cash flow was sent back to Omaha, where Buffett could then reallocate it into other wonderful businesses and investments. It became a gusher of capital that funded the growth of the entire Berkshire empire. See's Candies taught Buffett and Munger one of the most important lessons of their careers. It's often far more profitable to buy a wonderful business at a fair price and hold it for decades than it is to buy a fair business at a wonderful price and sell it after a few years. It proved that immense wealth can be created not through frantic activity, but through the patient ownership of a high-quality cash-generative asset. It is the ultimate case study in the financial power of just sitting on your ass. The human brain is wired for action. This instinct, which was essential for our survival on the savannah, is a massive liability in the world of modern investing. The two psychological drivers that create this destructive impulse are action bias and hyperbolic discounting. Action bias is our innate tendency to favor action over inaction, even in situations where restraint would be the more rational course. We feel that we must do something. When the market is volatile, the investor with action bias feels an overwhelming compulsion to sell something, buy something, change something. Sitting still feels like negligence. Researchers have even documented this in professional sports. In a study of soccer goalkeepers during penalty kicks, they found that goalkeepers who stayed in the center of the goal, who did nothing, had a higher success rate of stopping the ball than those who dove to the left or right. Yet goalkeepers almost always dive. Why? Because the social and personal pain of conceding a goal after doing nothing feels worse than conceding a goal after making a dramatic, albeit incorrect, dive. Doing something even if it's wrong feels better than doing nothing. In investing, this bias leads to constant unnecessary trading, which racks up fees, triggers taxes, and prevents any single investment from compounding to its full potential. The second, and more subtle bias is hyperbolic discounting. This is our tendency to have a stronger preference for rewards that are closer to the present time, even if they are smaller, than for rewards that are larger but further in the future. We discount the value of the future reward. This is why people struggle to save for retirement or stick to a diet. The immediate pleasure of spending money or eating a cookie outweighs the distant, larger reward of financial security or good health. In investing, hyperbolic discounting manifests as an eagerness to take small, quick profits. Selling a stock for a 20% gain after a few months provides an immediate hit of gratification. It feels good now. The idea of holding that same stock for 20 years to potentially achieve a 2,000% gain is abstract and distant. The future reward is so heavily discounted that the investor chooses the immediate, smaller payoff. The punch card philosophy, combined with the sit-on-your-ass strategy, is a direct and powerful antidote to both of these biases. The scarcity of the 20 slots naturally curbs the action bias. You can't afford to be constantly trading when each decision is so precious. It forces you to adopt a long-term perspective. Furthermore, the act of holding a concentrated position in a wonderful business helps overcome hyperbolic discounting. When you own a significant stake in a company like See's Candies, you begin to think like an owner. You see the business generating cash flow year after year, and you start to appreciate the long-term value creation. Your focus shifts from the short-term stock price fluctuation to the long-term trajectory of the business's intrinsic value. You begin to value the larger, later reward more appropriately, and the temptation of the small, immediate gain fades away. To cultivate this critical skill of patience, we can employ a mental model I call the 10-year test. This is a practical framework designed to force a long-term perspective on every investment decision, effectively hardwiring patience into your process. It consists of 3 key components. The first is the pre-mortem. Before you even think about punching your card and buying a stock, you must perform this powerful thought experiment. Imagine it is 10 years in the future, and your investment in this company has been a complete and utter disaster. It's down 90%, a total wipeout. Now write the story of what happened. What went wrong? Did a new technology disrupt the business? Did a key patent expire? Did management make a series of terrible capital allocation decisions? Did the competition simply out-execute them? This exercise forces you to move beyond the optimistic bull case and confront the real, fundamental risks to the business. It helps you distinguish between temporary stock price volatility and the potential for permanent capital impairment. If you can't come up with a plausible story for failure, you haven't thought about it hard enough. The second component is the 10-year thesis. If the company passes the pre-mortem test, you then must write a clear, detailed thesis explaining why you would be happy to own this business, even if the stock market were to shut down for the next 10 years. This is a critical question. It forces you to ignore all short-term market noise and focus exclusively on the long-term, durable characteristics of the business itself. What is its economic moat? Why will customers still be buying its products or services a decade from now? What gives it a sustainable competitive advantage that can withstand the tests of time, technology, and competition? Your written thesis becomes your anchor in any future market storm. The third and final component is the quarterly thesis check. This is your new review process, replacing the destructive habit of daily price checking. Once every 3 months, you will take out your written 10-year thesis and read it. Then you will review the company's latest quarterly report, conference call, and any other relevant news. Your goal is not to see if the stock price went up or down. Your goal is to ask one, and only one, question. Have any facts emerged in the last 90 days that fundamentally invalidate my original 10-year thesis? If the answer is yes, for instance, if a key patent was lost or a disruptive competitor has emerged and is rapidly taking market share, then you have a potential reason to sell. But if the answer is no, and the business is simply facing a temporary headwind, or the stock market is in a general panic, you do absolutely nothing. Your thesis remains intact, and therefore your holding remains intact. Using this 10-year test framework, the pre-mortem, the thesis, and the quarterly check systematically re-engineers your brain. It replaces short-term emotional reactions with a long-term, disciplined, business-like approach. It is the operating system for patient capital. The antithesis of this patient, long-term approach is the hyperactive mindset of the day trader or the so-called active investor. This is the path of the 99% in its most extreme and destructive form. Picture this individual. They are glued to a screen with multiple monitors, displaying flashing charts, news feeds, and social media streams. Their entire day is a frantic series of reactions. A positive economic data point is released, they buy. A negative tweet from an influential figure, they sell. A stock hits a technical resistance level, they sell. It breaks through a support level, they buy. They are a puppet, and the market's daily noise is pulling the strings. This individual often speaks a language of false sophistication. They talk about stop losses, trailing stops, and profit targets. But what are these tools really? A stop loss is a preset order to automatically sell a stock if it drops to a certain price. It is a system designed to force you to sell low. It is an abdication of judgment, replacing a careful analysis of business value with a blind reaction to price movement. It ensures that you will be shaken out of good, long-term investments during periods of normal market volatility. The financial and mental costs of this hyperactive approach are staggering. First, there are the direct costs. Commissions and fees from constant trading act as a constant drag on performance. More importantly, this strategy is incredibly tax inefficient. Any gains are short-term, taxed at the highest marginal income tax rates, often slicing 30 to 40% off the top of every single winning trade. The compounding process is not just crippled, it's virtually impossible. Then there are the mental costs. This is an exhausting, anxiety-inducing way to live. It is a full-time job that pays less than minimum wage for the vast majority who attempt it. It is a statistically losing game, a zero-sum competition against high-frequency trading algorithms and the most brilliant minds in finance. The day trader is bringing a knife to a gunfight. They are mistaking motion for progress, activity for achievement. They are engaged in a form of financial theater, playing the role of a serious investor, while in reality they are simply gambling. It is the polar opposite of the calm, deliberate, and immensely powerful strategy of identifying a great business and then patiently, quietly doing nothing at all. The direct financial connection between patience and wealth creation is one of the most powerful forces in the universe, the miracle of uninterrupted, tax-deferred compounding. When you understand this, you will never look at trading the same way again. Let's imagine a simple scenario. You have two investors, both of whom are skilled enough to generate a 20% pre-tax return on their investments each year. Investor A is a hyperactive trader. They achieve their 20% return by buying and selling stocks throughout the year. At the end of the year, their gains are classified as short-term capital gains and are taxed at a rate of 35%. So their real after-tax return is not 20%, but 13%, 20%, 1 to 0.35. Investor B is a patient, punch card investor. They find a wonderful business and hold it. Their 20% return comes from the appreciation in the value of their long-term holding. Because they don't sell, they don't trigger any taxes. Their capital is allowed to compound at the full pre-tax rate of 20%. Now, let's give each of them $100,000 and see what happens over 20 years. Investor A, the trader, with their 13% after-tax return, sees their capital grow to approximately $1.15 million, a very respectable sum. But Investor B, the patient holder, whose capital compounds at the uninterrupted rate of 20%, sees their initial $100,000 grow to over $3.83 million. The difference is more than $2.6 million. That is the price of impatience. That is the frictional cost of constant activity. It's the money you are voluntarily handing over to the government and the brokerage houses instead of allowing it to work for you. By adopting the sit-on-your-ass strategy, you are not just being patient, you are making a conscious, strategic decision to maximize your after-tax returns. You are treating your investment portfolio as a single, compounding machine, and you are refusing to do anything that would unnecessarily interrupt that process. Every decision to sell a long-term holding must be weighed against this enormous tax burden. The new opportunity must be so compelling that it can overcome not only the value of the current holding, but also the significant tax cost of making the switch. Most of the time, the best course of action is to simply let the compounding machine run. This is not a passive strategy. It is a profoundly active decision to harness one of the most powerful financial forces on Earth. We now arrive at the fourth, and perhaps most demanding, pillar of the punch card philosophy, the research imperative. If you are going to limit yourself to only 20 decisions in a lifetime, and if you are going to hold those decisions for decades, then the level of due diligence required before making a punch must be immense. You cannot rely on a stock tip, a news headline, or a cursory glance at a financial statement. You must adopt a know-everything mandate. Your goal is to understand the business you are buying as well as, or even better than, its own management. You're not buying a stock. You are buying a piece of a business, and that requires the thorough investigation of a prospective owner. The quintessential example of this deep obsessive research is Warren Buffett's decision to invest over $1 billion in the Coca-Cola Company in the late 1980s. This was not a casual investment. It was the result of a multi-decade fascination and a period of intense, focused analysis. Buffett had been a consumer of Coke products his entire life, famously drinking at least 5 cans a day. He understood the product's appeal on a personal level. But his analysis went far, far deeper. He started by going back and reading decades of Coca-Cola's annual reports, tracing the company's history, its financial evolution, and the strategic decisions made by its leadership over the years. He wasn't just looking at the numbers, he was trying to understand the soul of the company. He studied the brand. He recognized that Coca-Cola was not just a name on a can. It was one of the most powerful symbols in the world, representing happiness, refreshment, and American culture. This brand equity created a powerful moat in the minds of consumers, a competitive advantage that was almost impossible for a rival to replicate. But he didn't stop there. He engaged in deep scuttlebutt research. He traveled and talked to people. He met with bottlers to understand the economics of the distribution system. He interviewed competitors like PepsiCo to understand their strategies and weaknesses. He visited store owners and restaurateurs to see how they thought about the product and its pricing. He even conducted his own informal market research, calculating the per capita consumption of Coke in dozens of different countries and comparing it to the consumption in the United States. He saw the enormous, untapped potential for international growth. He saw that in many countries, people were consuming just a tiny fraction of the Coke that Americans were, and he realized that as global incomes rose, so too would their consumption of this affordable luxury. He built his own financial model, not based on Wall Street's quarterly earnings estimates, but on his own deep understanding of the business's long-term unit case volume growth and its incredible pricing power. He concluded that the company was a phenomenal, unstoppable business that was, at that moment in 1988, following a market crash, trading at a very reasonable price. When he finally decided to invest, it was with absolute conviction. He invested over $1 billion, making it Berkshire Hathaway's largest single common stock investment at the time. It was a classic punch card decision, rare, large, and backed by an almost overwhelming amount of research. He wasn't guessing. He wasn't speculating. He knew. This know everything mandate is the price of admission for making high-conviction, concentrated bets. The punch card's strict limit on the number of your decisions serves as a powerful psychological antidote to two of the most dangerous cognitive biases an investor can face: the Dunning-Kruger effect and its close relative, overconfidence bias. The Dunning-Kruger effect is a well-documented phenomenon where individuals with low ability or knowledge in a particular domain tend to dramatically overestimate their competence. In essence, they are too ignorant to recognize their own ignorance. In investing, this manifests everywhere. A novice investor reads a couple of articles online, watches a few videos, and suddenly feels they are an expert on a complex topic like semiconductor manufacturing or biotechnology. They mistake a little bit of surface-level knowledge for deep, genuine understanding. This false confidence leads them to make reckless bets on companies and industries they have no business investing in. The Dunning-Kruger graph famously shows that as a person's knowledge in a subject begins to increase from zero, their confidence shoots up to an initial peak, which is wryly called Mount Stupid. The punch card philosophy is a forced march off of Mount Stupid. When you know a decision is one of only 20 you will ever make, the weight of that choice forces a degree of humility. You are compelled to ask, do I really know enough about this to make it a lifetime commitment? This question forces you down into the valley of despair on the Dunning-Kruger graph, the point where you realize how much you don't know. It is only from this valley of intellectual humility that you can begin the slow, arduous climb up the slope of enlightenment through genuine, hard research. Related to this is the overconfidence bias, our general tendency to be more confident in our own judgments and predictions than is objectively warranted. We overestimate the precision of our knowledge and our ability to forecast the future. In investing, this leads people to create overly precise financial models that project earnings out to 5 decimal places, believing they can accurately predict the future of a complex, dynamic business. The punch card system tempers this overconfidence. By forcing you to focus on only a few things, it allows you to go deep enough to see the true complexities and uncertainties of a business. A deep understanding of a company doesn't lead to more confidence in your ability to predict its exact quarterly earnings. On the contrary, it leads to a deeper appreciation for all the things that can go wrong. Your confidence, therefore, is not placed in a precise forecast, but in the qualitative, durable aspects of the business, its competitive moat, the quality of its management, and the strength of its balance sheet. You become confident in the company's ability to withstand an uncertain future, rather than your own ability to predict it. The scarcity imposed by the punch card is a powerful tool for self-awareness. It forces you to confront the limits of your own knowledge. and to substitute shallow, misplaced confidence with a deep, earned conviction. To execute this know-everything mandate, you need a structured research process. The most effective method is the scuttlebutt approach, a term popularized by the legendary investor Philip Fisher in his book Common Stocks and Uncommon Profits, and later adopted and mastered by Warren Buffett. It's a method of investigation that goes far beyond the public financial documents and seeks to build a mosaic of understanding from on-the-ground, qualitative sources. It can be broken down into a four-stage blueprint. The first stage is, admittedly, the most conventional: read the documents. But you must go deeper than the average analyst. Don't just read the latest annual report. Read the last 10 years of annual reports, 10 kilosecond, and shareholder letters. This allows you to see how the business has evolved, whether management has been honest and consistent in its communications, and how they have allocated capital over a full business cycle. You should also read the last 10 years of quarterly conference call transcripts. This is where you can hear the unscripted questions from sharp analysts and listen to the tone and candor of the management team's responses. The second and most critical stage is to talk to the people. This is the heart of scuttlebutt. Your goal is to understand the business from every possible angle. Try to talk to former employees. They can provide an unfiltered view of the company's culture and operational efficiency. Talk to customers. Why do they choose this company's product or service? How loyal are they? Talk to suppliers. Are they being treated well? Are they seeing strong and consistent orders from the company? And, most importantly, talk to competitors. They have the strongest incentive to point out the company's weaknesses and vulnerabilities. You will learn more about a company's competitive advantages by talking to the people who are trying and failing to compete with it. The third stage is a specific technique called the channel check. This involves investigating a company's distribution channels to get a real-time pulse on the business's health, independent of what management is telling you. If it's a retail company, visit the stores. Are they busy? Is the morale of the employees high? Is the inventory moving? If it's a software company, talk to its sales partners. Are they closing deals easily? Are customers happy with the product? This kind of on-the-ground research can often detect shifts in business momentum long before they show up in the quarterly financial reports. The final stage is to build your own model. After gathering all this quantitative and qualitative data, you must synthesize it into your own simple financial model. This should not be a complex 80-tab spreadsheet from a Wall Street firm. It should be a simple model built on your own, conservative assumptions about the key drivers of the business's value, things like unit growth, pricing power, and profit margins. The purpose of this exercise is not to arrive at a single, precise number for the company's value, but to understand the range of potential outcomes and the key variables that will determine its success or failure. This rigorous four-part scuttlebutt process is hard work. It takes time and effort. But it is what it takes to earn the right to punch one of your 20 slots. It is the only way to develop the deep, unshakable conviction necessary to hold a concentrated position through the inevitable storms of market volatility. The antithesis of the deep research-oriented business analyst is the story stock investor. This type of investor is seduced not by balance sheets and cash flow statements, but by compelling narratives. They are drawn to charismatic CEOs, revolutionary technologies they don't fully understand, and grand visions of changing the world. Their research process consists of watching a few slick marketing videos, reading some enthusiastic social media posts, and looking at a stock chart that is going up and to the right. They are investing in a dream, not a business. The market is full of these story stocks, especially during bull markets. Think of a company with a great-sounding concept. We're using artificial intelligence to revolutionize the pet food industry, but with no revenue, no profits, and no clear path to profitability. The story stock investor buys in, caught up in the excitement and the fear of missing out on the next big thing. They don't understand the technology, they haven't analyzed the competitive landscape, and they have no way of valuing the business because there are no fundamentals to value. They are simply betting that the story will continue to get more exciting, and that someone else will be willing to pay a higher price for that story in the future. This is not investing. It is pure speculation. The problem is that stories are fragile. A charismatic CEO can leave. A competing technology can emerge. The market's sentiment can shift on a dime. When the story breaks, the stock price collapses. And because the story stock investor has no anchor in the fundamental value of the business, they have no basis for making a rational decision. Their only data point, the upward-sloping stock price, is now gone. Lacking any real conviction based on deep knowledge, they panic and sell at the bottom, locking in devastating losses. They are left with nothing but the painful lesson that a good story and a good investment are often two very different things. The punch card investor, with their mandate for deep research, is immune to the siren song of the story stock. Their process forces them to look past the narrative and focus on the economic reality. They are buying businesses, not tales. And that is why, over the long run, they are the ones who build lasting wealth. The direct financial outcome of this intensive research imperative is the creation of a margin of safety. This is perhaps the single most important concept in all of value investing, first articulated by Benjamin Graham and adopted as a bedrock principle by Warren Buffett. The margin of safety is the difference between the intrinsic value of a business and the price you pay for it in the market. The entire purpose of your deep, scuttlebutt research is to arrive at a conservative, well-supported estimate of a company's intrinsic value. Let's say, after all your work, you conclude that a business is conservatively worth $100 per share. The margin of safety principle dictates that you do not buy the stock at $100. You don't even buy it at $90. You wait patiently until the market, in a moment of fear or neglect, offers it to you at a significant discount, perhaps $60 or $50 or even less. That discount, that $40 or $50 gap between value and price, is your margin of safety. This is not just a theoretical concept, it is a tangible financial buffer that provides two critical benefits. First, it provides powerful downside protection. Investing is a game of probabilities, not certainties. Even with the most thorough research, you can be wrong. The future is inherently unpredictable. The margin of safety ensures that if you have made a mistake in your valuation, or if the business encounters unexpected headwinds, you have a cushion that protects your capital from permanent loss. If the business turns out to be worth only $70 per share instead of your estimated $100, but you paid only $50, you still have a successful investment. It is the financial equivalent of building a bridge that can carry 30,000 pounds, but only ever driving a 10,000-pound truck across it. Second, the margin of safety is the engine of outsized returns. By buying $1 of value for 50 cents, you are preloading your investment with enormous upside potential. The return to intrinsic value alone provides a 100% gain. And as the wonderful business continues to grow and increase its intrinsic value over time, your returns are magnified even further. This principle fundamentally changes the risk-reward equation of investing. It is the direct financial reward for your hard work and research. The market is an emotional, often irrational beast. It swings from manic euphoria to depressive pessimism. The disciplined researcher waits for the moments of pessimism to buy wonderful businesses at prices that provide a massive margin of safety. This single practice is the key that transforms concentrated investing from a reckless gamble into a rational, prudent, and highly profitable long-term strategy. It is the ultimate financial connection between knowledge and wealth. Finally, we ascend to the fifth and final pillar. This is where we elevate the punch card philosophy from a simple stock-picking tool to a comprehensive worldview on capital allocation. This is about adopting the CEO mindset. Whether you are managing a multi-billion-dollar corporation, a small business, or your own personal savings, the fundamental challenge is the same: how to allocate finite capital resources to achieve the highest possible long-term return. The 20-slot punch card is not just for investors. It is a universal framework for making better strategic decisions. The ultimate story of this scaled-up philosophy is Buffett's monumental acquisition of the Burlington Northern Santa Fe (BNSF) Railway in 2009. This was not a stock pick, it was a $44 billion purchase of an entire company, Berkshire Hathaway's largest acquisition ever. To understand this decision, you have to place yourself in the dark days of late 2009. The world was still reeling from the great financial crisis. The American economy was in a deep recession. Fear and uncertainty were everywhere. Making a massive multi-billion-dollar bet on the future of American industry seemed, to many, like an act of madness. But Buffett, as CEO of Berkshire, was looking at this decision through the exact same punch-card lens he had used for decades, just on a much grander scale. His punch was not for a few $1,000,000 of stock, but for an entire essential artery of the U.S. economy. He had done the research, he understood the railroad business. He knew that it had a powerful and durable moat. It is virtually impossible to replicate a nationwide rail network. It's a duopoly in most parts of the country. He recognized that railroads are incredibly capital-intensive, but once the infrastructure is in place, they are highly efficient and profitable ways to move goods. He saw that as the population grew and the economy recovered, the demand for moving raw materials, agricultural products, and finished goods would inevitably increase. The investment in BNSF was, as he famously stated, an quote, all-in wager on the economic future of the United States. It was a concentrated, high-conviction bet of the highest order. It was Buffett, the capital allocator, using his CEO-level punch card to direct a massive amount of shareholder capital into what he believed was one of the best possible uses for it for the next century. This was not about timing the market or making a quick buck. It was about owning a permanent, high-quality, cash-generative asset. The BNSF acquisition demonstrates the ultimate scaling of the punch card philosophy. It shows that this is not just a technique for managing a stock portfolio. It is a fundamental mindset about how to deploy capital in any context. For a business owner, the punches might be major strategic initiatives, building a new factory, acquiring a competitor, or launching a major new product line. For an individual, it might be about their career, which job to take, which skill to learn, which city to move to. In every case, the principle is the same. Because your resources of time, energy, and capital are finite, you must be incredibly selective, do your homework, and when you find a truly great opportunity, you must have the courage to bet big. Adopting this CEO-level mindset requires overcoming some of the most stubborn psychological biases that affect decision-making, particularly the sunk cost fallacy and the disposition effect. The sunk cost fallacy is our irrational tendency to continue with an endeavor simply because we have already invested significant time, money, or effort into it, even when it's clear that the future prospects are poor. A CEO might continue to pour money into a failing project because they've already spent millions on it, and admitting failure would be too painful. An investor holds onto a losing stock, thinking, "I can't sell now. I have to at least make my money back." They are making decisions based on the past, on unrecoverable costs, rather than on the rational assessment of future probabilities. The disposition effect is a specific manifestation of this in investing. It's the statistically documented tendency for investors to sell their winning stocks too early while holding on to their losing stocks for too long. Selling a winner provides a quick, pleasurable hit of realizing a gain. Holding a loser allows the investor to avoid the painful act of realizing a loss, hoping it will one day come back. This is a recipe for a portfolio full of weeds and a garden devoid of flowers. A true CEO-level capital allocator must be ruthless in combating these biases. The punch card framework is a powerful tool for this. It reframes every investment decision not as a reflection of the past, but as a fresh allocation of a scarce resource in the present. For each of your punched slots, the question is not, how much am I up or down on this? The question is, if I were starting with all cash today, would this business be one of the 20 best ideas in the world for me to invest in at its current price? This forward-looking perspective is the key. It forces you to constantly evaluate your holdings against their opportunity cost. If one of your 20 holdings no longer represents one of the best possible uses of your capital, a CEO mindset demands that you sell it, regardless of whether you have a profit or a loss, and redeploy that capital into a better idea. This requires a degree of emotional detachment and intellectual honesty that is rare, but it is the hallmark of every great capital allocator. They are not beholden to the past. They are relentlessly focused on optimizing the future. To implement this CEO mindset in your own financial and professional life, you can use a powerful mental model known as the opportunity cost framework. This is a system for making rational, high-stakes decisions by constantly comparing your options against your next best alternative. It's a blueprint for thinking like Buffett. Step 1 is to rank your opportunities. At all times, you should maintain a short, curated, and constantly updated list of your top 3 to 5 investment or business ideas. These are the ideas that have passed your rigorous research filters and are sitting on your ready list, waiting for the right price or the right moment. These are the only things worthy of one of your precious punches. Step 2 is to use this list to establish your hurdle rate. Your best idea on that list, the one you would invest in today if you had the capital, sets your personal hurdle rate. No other new idea, whether it's buying a different stock, starting a new project at work, or making a major purchase, should even be considered unless it promises a better risk-adjusted return than the number one idea you are currently not pursuing. This creates an incredibly high bar for any new commitment of your time or money, forcing you to say no to almost everything. Step 3 is to make liberal use of the too hard pile. A key part of the CEO mindset is not just knowing what to do, but knowing what to avoid. Actively and quickly categorize the vast majority of opportunities that cross your desk as too hard. This isn't a sign of laziness. It is an act of supreme intellectual efficiency. It conserves your finite analytical energy for the few pitches that are squarely in your circle of competence and have the potential to clear your high hurdle rate. This focus is a CEO's most powerful weapon. The final step, particularly for entrepreneurs and executives, is to conduct a regular capital allocation audit. Once a year, step back and analyze how capital is being deployed within your business. Are you reinvesting your profits into your highest return projects? Or are you spreading the capital thinly across dozens of mediocre initiatives in the name of diversification? Apply the 20-slot punch card mentality to your own company's strategic plan. Identify the 1 or 2 initiatives that could truly move the needle, and concentrate your resources there. This framework, ranking opportunities, setting a high hurdle rate, using the too hard pile, and auditing your capital allocation, is the operating system of a world-class CEO. It transforms you from someone who reacts to opportunities into someone who systematically selects only the absolute best. The antithesis of the focused CEO capital allocator is the empire builder, or the activity-driven investor. This is the path of value destruction. The empire-building CEO is obsessed with growth for its own sake. They are driven by ego and a desire to preside over the largest possible organization. Their strategy is often a series of relentless, overpriced, and strategically incoherent acquisitions. The AOL-Time Warner merger is the textbook example, a disastrous attempt to combine 2 vastly different cultures and businesses that resulted in one of an unprecedented destruction of shareholder value. The empire builder mistakes size for success and motion for progress. They make dozens of punches, but each one weakens the whole. Similarly, the activity-driven investor feels a constant pressure to be doing something. They believe their value is demonstrated by the number of trades they make, or the complexity of their portfolio. They are constantly tinkering, rebalancing, and chasing the latest market fad. They over-diversify their business interests or their stock holdings into a sprawling mess that is impossible to manage effectively. This leads to bloated, fragile, and chronically unprofitable enterprises, whether corporate or personal. They are focused on the quantity of their decisions, not the quality. They are the managers of complexity, while the great capital allocators are the masters of simplicity. The punch card philosophy is a declaration of war on this mindset. It is a commitment to the profound truth that in business and investing, it is the quality, not the quantity, of your decisions that will ultimately determine your success. It is better to make one brilliant decision and hold it for a lifetime than to make 100 mediocre ones. The ultimate financial metric that connects all of this is return on invested capital, or ROIC. This is the single most important number for judging the performance of a business and the skill of its capital allocators. ROIC measures how much profit a company generates for every dollar of capital that has been invested in it. A high ROIC means the business is incredibly efficient at turning capital into profits. The entire 20-slot punch card methodology is a system designed to build a personal or corporate portfolio that maximizes long-term ROIC. By forcing you to be selective and patient, it steers you towards investing only in wonderful businesses that have high and sustainable returns on capital. By forcing you to insist on a margin of safety, it ensures you don't overpay for that quality. The financial impact of focusing on high ROIC businesses is staggering. Imagine two companies, both growing their revenues at 10% per year. Company A is a capital-intensive, low-margin business that earns a 5% ROIC. Company B is a capital-light, high-margin business that earns a 20% ROIC. To achieve its 10% revenue growth, Company A must reinvest all of its profits, plus borrow more money just to stay afloat. It creates no free cash flow for its owners. Company B, on the other hand, can fund its 10% growth by reinvesting just a quarter of its profits. The other 3/4 is free cash flow that can be returned to shareholders or reinvested in other high-return opportunities. Over time, Company B will become vastly more valuable than Company A, even though their top-line growth is identical. The punch card system is a filter designed to find Company B's and avoid Company A's. It is the practical application of a CEO mindset to your own financial affairs. It is the master key that unlocks the engine of long-term wealth creation, and it is the ultimate lesson in financial education for anyone who aspires to move beyond simply earning money to truly compounding it. You have just been handed one of the most powerful mental tools in the world of finance. The 20-slot punch card is more than an investment strategy. It is a complete philosophy for decision-making. It is a system that transforms you from a frantic gambler, reacting to every flicker of the market, into a calm, patient, and deliberate business owner. You have learned how to trade the illusion of safety that comes from diversification for the true safety that comes from deep knowledge. You have learned to weaponize your own psychological biases, turning the desire for commitment into a tool for discipline. You have learned to trade the exhausting, costly path of hyperactivity for the profound wealth-building power of patient inaction. This mental model is now part of your arsenal. But a powerful weapon is only as effective as the target it is aimed at. The punch card is the rifle, but that begs the crucial question: how do you identify the perfect target? Knowing how to be selective is the first step, but knowing what to be selective and more about is the master stroke. This entire system of concentration and patience is built on a single foundational premise: that you are investing in truly exceptional businesses. But what makes a business exceptional? What is the one non-negotiable trait Warren Buffett demands in every single company he buys? The single characteristic that underpins the multi-decade success of companies like Coca-Cola and See's Candies. It isn't rapid growth, it isn't revolutionary technology, it isn't even a statistically cheap price. It is a powerful and durable competitive advantage, a concept he famously calls an economic moat. The video that is now appearing on your screen is the next critical piece of this puzzle. It is a deep dive into that very concept. It is the lens through which you must view every potential investment before you even consider using one of your 20 precious punches. You have built the foundation of a world-class investment mindset here today. Do not stop now. The average person collects isolated facts and financial trivia. The master investor, the true capital allocator, builds a latticework of interlocking mental models. You have just forged a critical link in that chain. The next link, The one that connects everything you've learned today to the real world of business analysis, is waiting for you. Prove to yourself that you are on the path to mastery. Click the video. Continue your ascent. Complete your mental arsenal.